It's my pleasure to tell you something about Aegon's perspective on corporate venturing. Until recently, ran Aegon's strategy function, and in that role, helped to set up our venture fund 4 years ago. And during that period, I also chaired the investment committee. Now, I don't claim to be a seasoned venture capitalist, but I am very proud of what our team has achieved in those years. And over the next 15 minutes or so, I'd like to tell you the reasons why. I'd like to start, and I need my little clicker, by giving you a very brief introduction on Aegon. We are an international financial services company providing life insurance, retirement solutions, and asset management services, covering the life cycle needs of our customers. We operate under 2 brands, Aegon, mainly in Europe and Asia, and Transamerica in the US. Our venture fund is branded Transamerica Ventures, but we run a global portfolio with investments in the US, in Europe, and in Asia. We have a clear purpose as a company, and that is to help people achieve a lifetime of financial security. And that means that our strategy is to follow people across their life cycle. Typically, that would start by providing them with life insurance as they set up a family, then helping them with savings for education of their children or retirement savings, and later by providing a pension. And that means that some of our customers can be with us for more than 60 years, which is an extraordinarily long time. Our vision is really that secure futures need both smart financial planning, healthy lifestyles, increasingly as we all get older, and the right solutions at every stage of life. And we are committed to deliver on that vision by, first of all, providing the right products and services to our customers, but also making a broader contribution to society by providing research and ideas on healthy aging, retirement systems of the future. And finally, also through our investments. And there the key focus is to focus on a cleaner and healthier environment and the transition to a low-carbon economy, which will require billions and billions of investments going forward, as Marc also mentioned this morning. We expect that the ventures we invest in also contribute to this vision. And that means that ventures should not only be supplying us with smart technology that's helpful for us, but they should actually make it easier for us to establish more human contacts with our customers, but also have more impact on our communities. And that's something we look for in the ventures we interact with. So we see a couple of trends that are really driving the changes in our industry and also driving the demand for our products. First of all, through the combination of persistent low interest rates, increased longevity, higher capital requirements, we see a shift away from guaranteed financial products to more investment-style solutions. And that means that there is increased risk and increased uncertainty for our customers. Secondly, we see government safety nets being reduced. We also see company-provided benefits packages under pressure. And as a result, the role of individual responsibility is increasing. And what we notice is that many of our customers really are not very well equipped for that. They either lack the awareness or the skills to deal with this. And thirdly, of course, the impact of digital. Customers increasingly, demand the type of service, the type of ease of use that they're also getting at Amazon, Uber, Spotify, and they're expecting that from their financial services providers. So the digital revolution is everywhere, and it's changing our industry in a significant way and opening it up to disruptors, and I think there will be a couple of those here later today. The thing that's caught most attention has been initially on the digital marketing side. And we've seen aggregators and direct digital competitors emerging. However, they've made big inroads in banking, but also in things like car insurance and household insurance. So far, we've seen less of that in pensions and life insurance. And that could be because customers still, many customers at least, still need some form of human assurance when they buy a complicated financial product. What we also see in many of the business models of the startups, that the acquisition costs, the digital acquisition costs of customers are just too high for the product margins involved. But it would be very foolish for us to be complacent, and we certainly are seeing technology playing a big role across nearly all steps in our value chain. And I won't go through all of these, although we actually are investing in most of these areas. But just two examples, we see big potential for technology, and particularly technology supported by AI, to change investment processes. And I mean, there are already examples of hedge funds that are using AI algorithms tied to satellite imagery to photograph oil storage facilities and get oil inventory estimates and then trade on those signals. So that's happening today. A little closer to home, claims management is also an area where AI-empowered algorithms are actually helping to make the whole claims process more smooth and get payment out quicker. Claims really are the moment of truth for an insurer, so anything we can do to make that as painless as possible is a great benefit. And at the same time, AI does help to identify the cases of fraud that are regrettably also a part of our industry. So how are we dealing with this? As a company, we are investing in innovation at 3 different levels. We're investing in innovation in our core operations, our home planet, as it were. We're building satellites, and we're also trying to explore the broader innovation universe, if I may make use of this space metaphor. If we think about our core operations, our home planet, we're looking and we're working with companies to robotize manual processes, working with companies like Automation Anywhere or Blue Prism to take these manual steps out of these legacy processes that we have and probably will still continue to have for many years. In satellites, we are building new businesses standalone, away from our established operations, in order to bring new ideas to market much more quickly than we otherwise could. And to give you 2 examples, we are the founders of Knap, which was the first full-service digital online bank in the Netherlands. It now has about 200,000 customers, and it has some of the highest customer satisfaction scores in the Netherlands. Nearly half the customers come from self-employed, and that's a very fast-growing segment in the Dutch market who have special banking needs that they find served by us at Knap. Now, if you look at Knap, it has leading technology, but equally important, it also has a culture that is very customer-centric, and that's driven by customer service reps, most of whom have no background in banking whatsoever. Second example is GoBear. GoBear is a joint venture that we set up with a fund linked to BCD Travel. BCD Travel is one of the largest international travel groups, and we partnered with them to set up a so-called meta aggregator in Southeast Asia, where customers can do comparison shopping on a range of financial products from credit cards to insurance. The business started in 2014. It's now active in 7 Southeast Asian markets. It has served about 45 million customers. And we were able to combine BCD Travel's aggregation experience with our financial know-how. Now, if you look at both of these examples, the common feature is that they are far away from our corporate head offices, and they've been able to build these businesses with a customer-centric and entrepreneurial culture, an attribute that you perhaps don't always associate with an insurance company when you first think of us. Now, thirdly, and maybe the reason why we're here today, is our venture fund. This is really our third innovation instrument. We set up this fund about 4 years ago. It's a $140 million fund. We invest mainly in A rounds and B rounds of technologies that are relevant to our business, because the fund has two objectives. One, we hope to build a portfolio of profitable investments, but secondly, and perhaps more importantly, what we want is to see the cross-fertilization between these portfolio companies and our business units to help our own transformation as a business. The fund is run by Georg Schwegler in New York and by Egbert Bierman in Europe. And over the past 4 years, they've built up this portfolio. We currently have 18 portfolio companies. And I'll tell you a little bit more about 3 of them, Everplans, Next Capital, and H2O. So an Everplan is a place where you can store everything that your loved ones will need should you not be there anymore. It's a digitally secure vault where you can store passwords, your will, your funeral wishes, and which you can share with people that you designate. So just one quick question for you. Who in your family actually has the PIN code of your mobile phone? Because that might be very useful for them one day. And an Everplan is somewhere where you could store that. So Everplans has a direct-to-consumer offer, but Transamerica, our US company, actually uses it through their brokers for brokers to engage with their customers. And it's a great way to strengthen a customer relationship, and also for a broker to make a relationship with the next generation of customers. Second example is Next Capital. Next Capital deals with one of the most fundamental problems of the financial services industry, and that is, how do you provide cost-effective advice and guidance to customers on investment products? And Next Capital provides a white label solution that Transamerica uses in its individual retirement customers business, supplemented with the human advisors in our advice center. And it's been a very successful company. We see more and more financial institutions adopting the white label Next Capital technology. And the big advantage for Next Capital is that they're growing their business without burning through large amounts of marketing cash. H2O. H2O.ai is a machine learning and open source machine learning and artificial intelligence platform used by hundreds of thousands of data scientists now, more than 18,000 companies in the world. The company's vision is to use AI to do AI, to make it more easy for AI to be applied. Their latest product is called Driverless Ai, which sounds quite terrifying. But what it does, it takes complicated tasks such as model selection, which typically requires a very experienced data scientist to spend a lot of time on, and tries to automate that process. Now, I won't tell you much more about it because I would rapidly be out of my depth, but I really encourage you to look at their products and test their products and look at their site as well. Aegon, we use H2O.ai to drive some of the AI algorithms that we use for customer retention programs or cross-sell programs. So about the fund. We think the fund provides a great platform to work with fintechs, and it's not just the investments. The investments are just the tip of the iceberg. So if you look at our fund team, they do about 80 to 100 commercial introductions of fintechs to our business units per year. And those result in about 10 commercial partnerships and about 5 investments per year. And the fund has done a lot for Aegon as well in the time. First of all, it gives us an overview of technologies and the fintech landscape. But more importantly, perhaps, The team really challenges our management to sharpen our technology vision, to experiment more, and also to change our ways of working. The team is pretty thick-skinned, and they also stand outside the hierarchy of the company, so they are not afraid to give us their direct views of what's wrong with our company and what the things are that we need to fix. And we've benefited a lot from them. It means that we are much more capable now of screening technologies, screening startups, making it easier for fintechs to work with us, even though we still operate in a regulated environment. And generally, I think we now also have the technology architecture that we can switch in and switch out fintechs as technologies evolve and companies evolve. I'm going to speed up a little bit because I see this ticker here, with just some final thoughts on where the industry is going. I think when fintech and the startups and big tech were initially mainly positioned to disrupt incumbents fully, but actually we see different business models emerging now. On the one hand, we see that fintechs that are providing their technology to incumbents can often have a much bigger impact than going it alone. And similarly, tech giants are also partnering with incumbents in a greater deal. If you look at China, for example, if you see the web of relationships that companies like Tencent and Alibaba are building, they're clearly working with incumbents as well as competing with them. And although competition is clearly going to be a feature of the market going forward, I think we're going to see many more cooperation models and ultimately also some convergence. Going back to China again, look at a company like Ping An. It started as an incumbent, but today Ping An is clearly a disruptor and a big tech player in its own right. So I believe very strongly that in future, every successful financial services company will have to be a tech company at heart as well. So that's really what I have to say. I'd be very interested in your views on how the industry is going to evolve and what you think is going to happen. So I'd be happy to talk to you afterwards or in one of the breaks later today. If you'd like to work with our venture company, you are probably best off contacting my much more knowledgeable colleagues at ventures@transamerica.com, and they will be able to help you. Thank you for your attention.